Hey, welcome to another training. When to switch from an S corporation to a C corporation. Really rare cases, and that's exactly what we're gonna talk about today. All right. Let's do it. All right, awesome. When to switch from an S corp to a C corp, and what exactly are we going to cover today? We're going to talk about, first of all, what is the difference between S corporation and a C corporation? Okay, why do business owners actually choose to be taxed as a C corporation, even though it's a double taxation entity? Stay tuned. When should you not become a C corporation, right? And when should you consider a C corporation entity? And how can you actually switch your current S corporation to a C corporation? And really, should you do that? The pitfalls to watch out for, very important for you to know that. And then, of course, step-by-step process, how to file for a C corporation. Ladies and gentlemen, my name is Boris Mushev. I'm a CPA and a certified tax strategist. If you have not subscribed to my channel yet, every Tuesday, I release tax strategies to teach you tax planning strategies that will help you reduce your taxes. Go ahead and subscribe, hit that subscribe button. Well, hit the like button if you like the video, but really, most importantly, let's get right into it. So S corporation versus C corporation. Before we really understand how and when to switch from an S corporation to a C corporation, we really should understand the biggest differences between these biggest types of entities in our country, right? Now, S corporation only has one type of stock, right? It can have a voting and non-voting, but it can only have one type of stock. Whereas C corporation, it can have more than one type of stock. And most common, as you know, it's preferred stock and a common stock. Okay. Now, also, S corporation doesn't have a double taxation because S corporation reports all of its income and profits on a K1, and that K1 gets passed through to an individual owner. That owner is considered a shareholder. Okay. Then that shareholder reports that income on his personal tax return. So there is no taxation at the business level, at the S corporation level. The C corporation, on the other hand, has a taxation on the business level, right? So you pay taxes as a C corporation. It does not get passed down to you. And then when you take the money out of the C corporation, you end up paying this tax the second time. So you get taxed on a business profits, and then you also get taxed on the dividends that you take out from the business. That is really why one of the main reasons why small business owners choose not to be taxed as a C corporation. But hey, we're going to get right into it, right? Then S corporations have shareholder tax bracket rate. So when that income passes through to a shareholder pays tax at his tax bracket, whatever that individual tax bracket that he or she are in. That could be 10%, 15%, 25%, as high as 37%. Whereas a C corporation has a flat tax bracket of only 21%, regardless how much income you're making, right? As being that small business owners, you pay 21% flat tax rate. Okay. Now, S corporation also cannot have more than 100 shareholders, no more than 100 owners. Okay. Whereas a C corporation can have more than 100. That's why a lot of companies on a stock exchange, right, or public companies, I should say, are C corporations because they have way more than 100 shareholders. Okay. So that's really one of the key differences between S corporation and C corporation. By just looking at this, you would be like, well, it kind of makes sense to become an S corporation being a small business owner. And you're right, in most cases it is. But today, we're going to talk about when does it actually make sense to be a C corporation? And why do business owners choose to be taxed as a C corporation? First of all, it's a flat tax rate. Remember, if you are at 37%, if you are at 37% tax bracket as an individual, you are paying tax at the highest tax bracket. Whereas having your income in the C corporation, you only end up paying 21%. You might say, well, Boris, there's double taxation, right? I can take the money out. When I do take the money out, then I'll end up paying dividend tax on it. So I'm back to double taxation. You are right, but not so quick, right? If you are using tax planning and you annually tax planning for yourself and for the profits that the business is bringing in, you can reduce your tax burden by tens or even hundreds of thousands of dollars actually using C corporations and using it properly using tax planning strategies. So remember, if you have a tax preparer, you do not have a tax planner. Obviously, everything that I teach you over here requires, careful planning, right? Now, C corporations also have what's called accumulated earnings. That means the money stays in the C corporation, which is generally is taxed for additional tax of A and P, accumulating earnings and profits, but you can actually avoid paying that tax if C corporation needs to retain its capital to invest, right, or to invest back into business or into more real assets such as real estate. If you take a look, for example, at companies, big corporations, Facebook or Microsoft or any other these types of companies, they have a lot of Apple, right? They have a lot of cash on hand. They don't pay accumulated earnings and profits tax. Why? Because they need to use this money to expand the business. So is there a way for you not to pay it? Yes, of course. But again, careful tax planning is absolutely needed. Tax deduction for fringe benefits and salary and bonus write-offs. This specifically refers to one-owner employees. So if you have a business and you are the only employee, you don't have any other employees or what's not, right? Whatever it is, you run it yourself. I've seen successful businesses run by one employee and they make a couple of $1 million, small businesses, which is awesome business model. Guess what? Being an S corporation, you can't have fringe benefits, but being a C corporation, you can actually write off fringe benefits, provide benefits to yourself as an employee of a C corporation, and then be eligible for those benefits. Okay. Also, it's easier for you to attract financing and going public. We had clients that needed to go public, and guess what entity was really helpful in doing so and attract proper financing? That is a C corporation. So if you have big plans for your C corporation, if you have big plans for your business, right, you need careful planning and figuring out, hey, S corporation or C corporation? Yes, S corporation makes sense on a short term, but does it make sense on a long term? Depends on your goals and your circumstances, right, and your business ambitions, right? Really, really important for you to do kind of tax planning for yourself when going through that. Now, when should you really not become a C corporation, right? I'm watching this video, Boris. Looks like I can pay 21% tax versus 37% tax, but when should I actually not file a C corporation? When your business makes enough to feed your family, right? If you have a business that, let's say, profits $300,000-$400,000 and that supports your lifestyle, you do not want to become a C corporation. You will definitely overpay in taxes. You will definitely be subject to double taxation, because after you take out your salary, you'll have profit left over. As an S corporation, you can dip into that profit, take it out as owner distribution, and not pay dividend tax. But as a C corporation, you would dip into that profit as dividend distribution, and you would pay taxes again. So when your business is your sole bread and butter, you do not want to file for a C corporation. Careful planning is needed before you really go into the C corporation. Is C corporation a safe haven? I would say it is in some ways. You just need to know how to properly use it. It's a great strategy, by the way, right? When you know what you're doing and when you have the right people to do it with you. Remember, like I said before, if you have a tax preparer, you do not have a tax planner, okay? To pay less in taxes, you need tax planning strategies and you need to always carefully plan. Now, also, the second thing is that when you're not investing your money into real assets. So, for example, if you have a very profitable business, then you pay taxes as an S corporation, for example, at your highest individual tax bracket. Then you take your money and you invest it into real assets, such as real estate, for example. If you are that individual, right? If you're that individual, you need to consider becoming a C corporation and looking into that option. But if you're not investing in real assets and you're making millions of dollars in your S-Corp and you pay the highest rate of tax, but you have no plan what to do with your money, how to invest it to further reduce your liability, C corporation might not actually be an option for you. But again, make sure you do proper planning before you become a C corporation. And when should you consider a C corporation, right? Okay, Boris, I've learned this, but when should I become a C corporation? Well, first of all, when you have more than one business entity. Generally speaking, when my clients have more than one entity, I do not like to keep them all in an S corporation. I ask, what is the purpose of each entity? Define what is the purpose of each entity. What is your purpose in this entity? Because in most situations, clients have one business that is an operating business, that is their bread and butter, that makes money. The other business also makes money, but it's not an operational business. It's more like a side business, a byproduct of a business, and it generates good profit. Well, what can we do with that profit right now? Can we invest it in real assets? If we can, should we try to consider a C corporation and be taxed at a lower tax rate, right? These are the things you should be thinking about. right? And when you're ready to start investing into real assets, like I said in my example earlier, even if you have one business, but you're generating a very high profit and you're not using all of that profit to live off, you have a lot of money excess left over, then start considering investing into real assets such as real estate, right? Shielding your money in the C corporation, buying real estate, investing into real estate, and getting a huge depreciation write-off while using the lower taxed money from the C corporation. These are the things you should be considering as part of your tax planning, okay? All right, what's next? All right, cool. How to switch your current S corporation entity to a C corporation. So let's say you watch this video and you're like, all right, cool, this sounds great. I want to start working with a tax planner. Maybe you, Boris, right? All right, cool. Hey, you're always more than welcome to. There are links below. But let's say you decide to switch your current S corporation. You're like, all right, I've got an S corporation and I want to switch it to a C corporation. Can I do that? The short answer is yes, you can. But you gotta be aware. You have to be aware. Number one, once you elect the C Corp status, you cannot go back to being a C Corp, an S corporation for the next 5 years, right? Generally speaking, you cannot, unless you meet some exceptions, but in most cases you can. Number two, there could be potential forced distributions of assets. So if you have an asset that was valued at $100, but now you switched out of an S corp, you terminated your S corporation status, and the fair market value of that asset is not 500 anymore. Excuse me, not 100, it's 500, and you have no liability, most likely you may end up paying tax on a $400, which was a forced distribution because you're not an S corporation. It's like you took the money out, right? You really, really have to be careful about all of these things out there. Should you plan before you close down your S corporation, become a C corporation? You absolutely should, right? But what if you're good to go? No, there's no tax consequences. You don't need to become an S corporation ever again. What are the steps? Really, it's very simple. All you have to do is file an S corporation termination. You have to revoke your S corporation status, right? Terminate your S corporation status with the IRS. All you have to do is write them a letter and also have it signed by all the shareholders. And you have to do it before March 15th of each year. So most likely your business is a calendar year taxpayer, right? Most businesses here. So I'm doing it for calendar year taxpayers. So you've got until March 15th from the December 31st to file for that year. So for example, if you want to terminate your status for 2022 tax year, you have to file the revocation of an S corporation or a termination before March 15th of this year. All right. Now, step by step, how to file for a C corporation. Let's say you're like, look, I don't want to close down my S corporation or turn it into a C corp. I just want to file a brand new corporation. What should I do, right? Number one, you need to register your business name with your state, right? Register your business name, make sure that name is available. In most cases, if it's a fancy name, a catchy name, it could be that it's taken, right? You need to appoint officers to the corporation. Now, each state has their own rules if you're using an attorney, and I always recommend when you are doing things such as incorporating, filing for a tax ID number, anything of that sort, do not do it yourself. I can watch a YouTube video how to fix a broken sink, but can I really do it? No, right? No, so don't do it, okay? But when you're hiring somebody to file your C corporation, they should really guide you through the steps of appointing the officers of the corporation and so forth, right? You need to draft and file really articles of incorporation with the Secretary of State. Okay, so basically it's usually 2 to 3 pieces of page document, depending on the state. You sign that, your business name, the start date, and so forth. Some states would require you to include company bylaws, right? But your attorney that's working for you should be able to do that. You need to issue yourself a stock, right? A stock certificate, okay? You also need to apply for business license in your state if you need one. And most importantly, file an SS4 form for EIN number or apply for EIN online. But again, please, ladies and gentlemen, do not apply for EIN yourself. I'll tell you why. Even though it's so easy, even though IRS made it so easy, it's really, you put in the information, the EIN, and few checkboxes. You know what happens when you pick a wrong checkbox? You just don't know. You just pick a wrong checkbox. Just like me, if I'm try to be my own plumber, I'll unscrew a wrong pipe, okay? So what do I mean by that? When you check off the wrong box, IRS will give you a letter that you applied for EIN and say, oh, by the way, you now have to file this, and that tax return. Most common one I see is that people say, when they fill it out, they check off the question, oh yeah, I will have payroll. But in reality, They might not have payroll that year, right? For whatever reason. But now IRS is expecting for you to file payroll tax returns. Or if you choose the wrong entity type, they will expect you to file that entity. And when you file your tax return, it might get rejected. And your accountant will call you like, hey, your tax return was rejected by the IRS. You're like, what? Why? It all has to do how you file for EIN. So let the professionals handle it. You don't need to hire us. I'm not saying this so you can hire us. We actually do not file for articles of incorporation or apply for EIN for clients. I'm just letting you know, for you, it's something to be aware of. Anyways, thanks so much for watching, ladies and gentlemen. If you like this video, please hit the like button, hit the subscribe button. Every Tuesday, I release brand new tax strategies to help you pay less in taxes. Thanks so much. And now I'm going to try to end this.